All right, let's jump into it. We have a chance to do a bit of a weekly review, a bit of a weekend wrap, and that with it all. So where we at? Well, it's not 2 p.m. and that it is 10:58 on Saturday morning. So getting it done a little bit earlier, which is good. So actually gives them time to sort of think about something other than having the markets hanging over our head for the whole weekend. But look, 20th of September, so into the the last third of the month. Um, let's go through a little bit of stuff there. Kind of lost my train of thought. Only 2 seconds into it, but look, it was a pretty big week. Everybody knows this. Okay, we had the retail sales. Just having a look at there, FOMC was the big one. This is the one that we've been sort of waiting on for a long time. I think this was quite significant. Obviously, I'll get to this sort of when I get into the charts as well. But this was a bit of a pivot point. Well, maybe not a pivot, but at least a scaling back of what the market had been looking at in terms of sort of what the Fed was going to do. So it was a two-pronged thing. One, it was kind of like a release valve. Like everyone's like, oh, it's coming, it's coming, it's coming, it's coming. Okay, bang. And now the rate decision's happened. 25 base point cut. We all know this. But as I said, it was scaling back of the whole idea that it's all about the jobs. And I think sort of it was kind of like a little bit of a hold on, hold your horses. Inflation is still one of the mandates, is still something we need to consider. Look, I've covered this daily on it all, so I won't sort of go into it too much. But I think this is quite significant. I mean, look, it's always a sort of significant bit of data, but I think it's quite significant at this point because I think, this could be leading to at least a little bit of a recalibration of sort of dollar short positions and that. Basically, is as the market tries to sort of hedge for possible outcomes. There's no point sort of going hammer and tong. I'm trying to think of a not a less crude sort of way of saying it, but going hammer and tongs towards sort of the idea that jobs is the only thing that's going to be driving their decision, and obviously sort of inflation is part of the equation there as well. Anyway, look, we saw all that stuff. Inflation numbers came back down. Philly numbers a little bit stronger. Retail numbers a little bit stronger. So the data out of sort of the US isn't too bad. And one of the points actually just on this topic is that one of the things that Powell said during his press conference, which was actually a response to a question there, but it rings true, is that the economic data isn't that bad out of the US, and this is on lower job numbers. So it's something to keep in mind because if they're doing okay, if you think about it, if you're running and still producing X amount, whatever, a decent amount, and you're on sort of skeleton staff, let's call it like that, break it down to a smaller level, a few sort of team members. Well, what happens when those job numbers recover? In theory, well, the people that sort of are added to the industry will also add to the sort of economic output, add to all this sort of economic data that we're getting, and that could sort of show a much stronger position for the US economy than against its peers, and against sort of what the market's really sort of been pricing for it. So it's just something to keep in the back pocket that sort of like, yeah, job numbers are bad, but you remember inflation is up, and the response to inflation is higher rates. If the jobs do recover, well, and inflation is persistent, well, it's a bit more of a clearer picture move forward for them to do to hold rates for a little bit more. And then you've got economic data strong on top of that. That's starting to set up a ballpark in which we could see some US dollar strength certainly coming through. Not saying, I mean, look, the thing is you don't make money necessarily by, well, you do, by sort of, taking a bit of a gamble on these sort of things, but it's important to be able to identify why and when these conditions will change, and we will see a prolonged amount of strength coming into the market because US dollar, man, it's been a tough trade in that last couple of months trying to sort of catch this thing, and it's just been a constant sort of letdown. Anyway, enough of that. Moving on, just yesterday we had BOJ rate decision. Look, it was pretty much widely expected that they were going to hold. It had a bit of a blip in the market. Actually, yen sort of strengthened a little bit sort of through that, but that was pretty much unwound pretty quickly. So there wasn't really a great deal to take away from that. And through the rest of the session, there wasn't really a great deal. We had this daily. I haven't actually seen the comments that they made there. I did see some comments by, I think it's Mirren, which is the new Fed member, the sort of Trump appointee that was sort of put on there. And as soon as he sort of jumped on sort of saying to the effect of like, oh, I hadn't even spoken to Trump about sort of what the position is, and then he sort of like said, hey, I was the person that put in the 50 base point. It's like, no, no one believes that you didn't speak to him, and no one's shocked that you were the 50 base point person calling for the 50 base point cut. So it's trying to give himself some sort of credibility, but I think it's pretty much falling on deaf ears. One quick sort of thing, just have a look on a little chart here, about 10:30. Yeah. So, I mean, I don't think this would have affected things too much, but we did see a bit of a turnaround in US dollar. Um, Around this time. But again, I don't think this was the reason or the catalyst for a little bit of sort of weaker data out of Canada there. I mean, look, if anything, that should have actually pushed DXY up. So it was just around that time, though. All right, so that was the week past, week coming up for data. So we've got Bullock speaking on Monday morning. See what she has to sort of say about things. Obviously, we had the jobs numbers out last week, and they were, weak. The unemployment rate is still holding at 4.2%. So most likely, she may sort of speak on this kind of stuff. The speakers and all this kind of stuff don't really have the same impact as I said the Fed speakers, and even the Fed speakers for as long as I can really remember don't really impact the market so much. It's only the last a couple of months since USL's been getting smashed. We had those couple of dissenters with Waller and Bowman. That the market would be like, oh my God, look how they're calling for a cut, and market would dump down. So speakers are fine. We'll have a look what she has to say, but I mean, I'm not expecting anything a great deal from that. Bit of China data at the same time. If anything, maybe this would affect things if we got a little bit of a shock here. But again, I just don't think that'll really sort of be the case. Mondays, as I said, they're a little bit sort of touch and go. Sometimes you get a bit of a flow on, but not really anything of super note here. And got a couple of sort of speakers later on there as well. And here's that Mirren, that's the name of the new person. That's one that did the 50 base point cut, or opted for the 50 base point cut. They're sort of speaking there as well, Tuesday morning. Nothing really of note, nothing really of note. So PMI, okay, so back to the PMIs and that. So PMI, obviously we'll tick through all of these. I would have thought, I think Aussie generally comes out with their PMI. Yeah, they do. I was going to say, I think Aussie comes out first with them, don't they? And 9 o'clock on Tuesday morning. Again, not going to be a big sort of mover. This is the one with a 50 base point, 50 base point, well, 50 point, whatever, 50 point baseline. So above 50 is expansion, below 50 is contraction, further away from 50 is larger expansion, and so on and so on, further underneath, bigger sort of contraction. What we've seen sort of kind of as a bit of a sort of global sort of thing at the moment is that services have generally been doing quite well, been holding up okay. And manufacturing has been a little bit on the weaker side. Actually, it doesn't sort of look like they're looking for that this time. But that seems to be the sort of feeling of it all. These things have the ability to get a knee-jerk reaction, but they're not really sustainable move kind of sort of move. So meaning sort of like, if you see a bit of a quick fly off this and you're in a position and it shoots up a couple of points, it shoots down a couple of points, and you're into a nice quick profit, I'd bank. Because generally they have the ability just to sort of fly up and then sort of come back down, particularly when you've got them in quick succession like this. The French one actually, we got French here? No, German. Just general Euro, French, yeah, yeah. So the French one actually seems to have been, for some reason, quite impactful of it all. Obviously, German sort of they're the larger sort of part of the Eurozone, but just it. I mean, look, it may have just been the couple of times that I've really been noticing it, but the French one tends to shoot it up like this, and then German comes out and it shoots back down. So yeah, they're just knee-jerk reactions. It's a piece of the puzzle to put in there, but I wouldn't sort of. It's not like, oh my God, we're really hanging our hat on that. Like most things, the US generally has the ability to move things a little bit more. And I think if you look at this as a little sort of snapshot of sort of where a couple of these countries are, it's sort of like, 50, 49, 48, 49, 49, 50, 50, 47, 54, 54, 53. So, not massively above, but it's significantly above what we're sort of seeing with these other bits of data here as well. And if you just sort of click on these little icons, gives you a sort of little bit of a breakdown of it. And this is what I was saying with that sort of 50 point is the sort of expansion, yada yada. Leading indicator of economic health, businesses react quickly to market conditions, and their purchasing managers hold perhaps the most current and relevant insights. So again, it's just a piece of the puzzle to sort of put in there. Well, a survey of 1,800 purchasing managers. Look, if you get big sort of outliers, you might get a bit of a sort of fast move, but again, it's not right up there as a big sort of number. Manufacturing, Richmond manufacturing. See how this one goes. We of course you seem to have the sort of the three main ones that I notice anyways. The Empire State, the Philly, and this one, the Richmond one. Again, it's not a big market mover. It's just something to plug in there. We saw Philly just absolutely dominate on those sort of numbers last week. But yeah, these things have the ability to really sort of fly around. This looks a little bit more stable, but again, look, forecasting -2, show me -20. I mean, look, it's all negative, put it that way. If it does hit a positive, it's just another tick in the camp over there. So pretty quiet, really, because PMI's, yeah, okay, so kind of thing in that. Powell speaking Wednesday morning. See what he's got to say. CPI, okay. Now, so we'll get into a little bit of the data. Monday, Tuesday seems to be the theme recently. Pretty quiet till Wednesday. CPI for Aussie, so 2.8%, 2.9%. Expected. So expected to tick up there a little bit. And maybe Bullock will have something to sort of say about this kind of thing sort of moving forward. This is going to be an interesting one because it was a big beat last month. If we have a look at, let's get rid of the graph for a second. So as you can see, sort of like, trending down, got down 2.1, got down to 1.9, and then bang, came in. Expected a little bit of a tick up. It's actually quite a big sort of jump. As you can see, it's generally sort of like within about 0.1, 0.2 of a percent. But it's certainly been trending down, and then all of a sudden, out of nowhere, bang, 2.8%. I'm not quite sure what the explanation is going to be for this, but I think this is going to be an important one because, we've seen a couple of bits of data recently, and I guess, yada yada tariffs and passing on and all this kind of stuff, even though Australia's stuck at, I think we got base rate 10% or something like this. It hasn't really sort of manufactured, shown up in the CPI. Um, well, I guess now it kind of has. But the point is this going to be an outlier? Is this going to be a month where it's just like, wow, that was a bit of a weird one, came out here, and now we're back down to 2.1, 2.2, 2.3. If we do get that, if we get a sort of 2.2, 2.3, something like a shock back down to here, because you can see the trend is coming down, 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 all of a sudden, bang. And this is what I mean. There's got to be some justification or reason for why this sort of spiked up. Actually, let me just see if I can see anything. All right, so here we go. So based on most recent data from the Australian Bureau of Statistics, key factors that led to a significant spike in the monthly consumer price index, CPI obviously, electricity prices, housing costs, holiday travel and accommodation, and food and non-alcoholic beverages. So, what I mean, a couple of these things, maybe sort of like, people sort of getting away for that mid-year little holiday or something could be something there. We all know that sort of housing's a little bit overblown. That's fine. Electricity is a largest contributor. Electricity surged 13%. Jesus, it's going up quick, isn't it? 13% with look at it. It's been surged by 13.1% in 12 months leading up to July, with a 13% increase in July alone. Okay. So what does it do? 1.1% in that leading up to that, and then 13% in 1 month there. The main reason for this is households in New South Wales, ACT, did not receive their usual government-funded energy bill relief funds payments in July, which was scheduled to receive in August instead. This timing issue caused a sharp one-off rise in out-of-pocket expenses. Now, I think look, I mean, this is a little bit above my sort of pay grade of things, but it would kind of sort of feel that, look, this would be the main sort of driver here. I mean, if you've gone up 13% in 1 month, and that's in July, and remember, CPI is always 1 month behind. So, if they're sort of, okay, they are, but they were scheduled to receive it in August instead. So now we're in September, so we're going to be getting the data for August. If they were going to get their relief bill then, and now they're sort of going to get their relief bill in August, in theory, this would be the big explainer for why CPI spiked. And you would think that that would then sort of come onto this month, and so we'll see a bit of a drop off here. So, I mean, look, again, this is me just sort of trying to put pieces of the puzzle together, but that could sort of definitely be something that could lead to a big sort of reduction. And we could see this little original trend come down here, spikes up because, okay, you know, the government's not paying for the stuff. Now they are paying for it, or they're paying for it the next month. I reckon there's a good chance we come in a lot lower. And if we do come in a lot lower, the repercussions are going to be that Aussie's going to get whacked on it because the job created last week, because again, Aussie's the same, like Australia's the same as the RBA, whatever, are the same as the Fed in the sense that they've got the dual mandate, jobs, so employment and inflation. Jobs were weaker last week. Yeah, unemployment didn't go up, but jobs added still were quite weak. And we've seen that, you know, same sort of thing in the US, that jobs added is all obviously a big factor with these sort of things as well, even if unemployment hasn't sort of decided to sort of shoot up as of yet. And again, if inflation is the other thing that's sort of keeping the thing in question. How, you know, inflation's up, and this is the whole sort of point of what we saw with the Fed this week. That, you know, and this is what Powell was saying. That sort of like, you know, hold your horses a little bit. Jobs is a factor, but don't forget about inflation. And inflation going up, the response to these two factors are very different. Like they're polar opposite. Inflation higher, you want to hold rates higher. Jobs, well, unemployment higher, jobs less kind of thing. You want to lower rates. So you've got these two sort of battling forces. If CPI is up higher, well, we're in the same position as, and probably even a little bit worse than that, same in the same position as the US, in which, you know, you don't want to cut rates into rising inflation because it'll just exacerbate the problem. But if this comes back down due to this potential sort of rate, government funded bill relief or whatever they're saying, and inflation comes back down, well, job numbers are still weak, and then inflation's not the issue. Jobs are still the issue. What's the response to jobs? Cut rates. And we already know that the RBA is on a cutting cycle. You know, they cut once. You know, they held through that extra one where I think it was widely sort of viewed that they probably should have cut, but they decided to hold to wait for that sort of quarterly CPI print. And then they started cutting, and the big wording that she used sort of through that press conference was that, you know, it's not a matter. Well, she said it's a matter of timing. So basically, it's not a matter of if, it's a matter of when. And now they've started the cutting cycle. Inflation spikes up. People question it. If inflation comes back down, they don't question it. We accept that they're cutting more rates. Aussie weakens. So that's the way to play this, and that's how I'll be looking at this. And then on top of that, if we see this US dollar buying coming through, you know, or at least sort of like short covering on US dollar short positions, that could exacerbate the problem as well. So I honestly think Aussie's in quite danger in that, and it has been surprisingly strong. Well, no, actually, sorry, I take that back. It hasn't been resilient. It hasn't been strong. It's actually been quite weak compared to how everything else has been running against the US dollar. But it's been bought on dips, bought on dips, bought on dips. And this is the thing. I think if we see the CPI drop off, I think Aussie's, yeah, in danger of sort of getting a little bit more of a whack. And 64.20, that's the major level for it to stay above. All right, anyway, enough of that. So that's going to be quite big. CPI is always a fairly big bit of data in that. Moving on from that, we got Japan, cool, BOJ, cool, CPI in that. So they're not worrying too much about that kind of stuff over there. Ticking forward, nothing really interesting, nothing of note, nothing of note. Another central bank on the Thursday, holding rates flat. So I think one interesting thing with these guys, because they're down at 0.0, they're talking about this is the Swiss SNB, so Swiss National Bank. They're talking about potentially going negative rates. So I think that's where the shock is on that. And if they go negative rates, that's another, I mean, albeit a very small factor. I think I looked at it the other day, it was like 3% or something it makes up of DXY. But it is something to factor in that excuse me, would have a sort of an upward effect on DXY should they go to negative rates. Ticking forward, nothing. GDP over there. So this will be probably something you'll get a bit of a movement. We've got a whole bunch of data coming out here, actually. We got GDP quarter on quarter, 3.3%. How's that sort of going for, you know, uh, not really enough to sort of take anything out of that chart. Um, wow, very, again, it's got to, when you get these sort of big moves like this, why has it gone 3%, 3.1, 2.4, negative 0.5? I mean, this just feeds into, hey, let's just sell the US dollar. But again, the flip side of this thing is if they get a 3.3, that's a big beat from where they were last month. Let's see if we can see why that sort of sold off there last month. Okay, so yeah, first of all, it's quarter on quarter, not month on month. But of course, this June number here, this June figure here, covers the April period where everybody, so, tariffs were coming in, or, all the talk of tariffs and all this kind of stuff. That was April when we got that big sell off. And basically, what seems to have been happening these 3 months, these sort of low areas, probably these two prints here. This is obviously a little bit higher. How's it go normally? Wow, 33%. 2020. Anyway, look, the most recent sort of times on that, look, 3%, 3%, 2%, and then that big drop off there. That was possibly due to, is the description is over here, or the explanation is over here, that we were seeing sort of front loading before the tariffs and everything were set to sort of come into effect. So, everybody sort of like gone ahead and rushed everything to sort of get it all sort of like pumped and done. And then sort of we're sort of seeing that, okay, there was a little bit of a drop off over here. Let's just have a look at this description here. So, US GDP was not negative in the most recent quarter. Well, looks like it was. Um, Q2. Okay, no, maybe this is a bit behind. Q2, actually a different one there. Anyway, whatever. Primary reason for GDP growth in the first quarter was a result of one-off technical factors related to international trade and how GDP is calculated. Yeah, front-loading of imports, businesses and consumers rushed to import a massive amount of goods in the first quarter to get ahead of new tariffs, which that were expected to take effect. Okay, we know that. And GDP calculation, the calculation of GDP, imports are subtracted. So, this unprecedented surge in imports led to a large negative contribution to the GDP figure, causing the overall number to be negative. Okay, so yeah, pretty much just due to, yada yada tariffs and that sort of coming in, why we saw a bit of a sell off there. So again, look, this is another thing that, these aren't the sort of gospel. It's not going to, like, you're not going to see the market change the full landscape because GDP came in a little bit stronger. But there's different tiers of importance with these bits of data. FOMC being tier one, CPI, NFP tier two, PCE, PPI, GDP, retails, they're sort of tier three. So, it's something that definitely you can plug in there. And if we come with a strong number here, this is what we're sort of talking about. And this is, back at the start of this video now, I said that sort of like, this is what he was talking about. That like, okay, take out this outlier month. Your numbers aren't too bad with lower jobs. So if you're sort of producing a level of which you're happy, 3.3% seems to be sort of decent for them, given sort of what, if we look back at the history over the last couple of years. So 3.3, it's about sort of, it's in the healthier side of what we can see through here. And you're doing that on lower jobs. If the jobs market does sort of recover and stabilize, and even if it adds, obviously, even more, in theory, it should add to what you're already producing. Otherwise, why are you adding more jobs if you're not actually adding to a better GDP, so better output? What's the point? And this is why I think you're getting people sort of question a little bit of sort of this whole jobs, jobs, jobs. It's all shocking, and the whole world's going to blow up because of that. Because you got GDP, which is not too bad. If you do add the numbers, and it brings us to the next one, unemployment claims. If this sort of again sort of sticks back around because we have that outlier back into its range. So if this stabilizes and then NFP adds, which is NFP is coming the week after this, these things could sort of see a little bit of a strengthening with the US dollar. Anyway, so ticking on, sort of spending a bit of time on the data today. Okay, where we got sort of durable goods, final GDP index, and that. So I don't really sort of cover the durable goods a great deal, to be honest. But this is a little bit sort of contrast to what I have been saying about all these other bits, looking like a little bit of an expectation of a little bit of a slowdown on this one here. Leading indicator of production, rising purchasing orders signal manufacturers will increase activity as they work to fill orders. So, I mean, this is the counter of it all. So we're seeing sort of possibly a little bit of sort of weaker sort of data over here. Durable, okay, actually just the core. The core looks to be slowing down. Durable goods month on month. What's the difference between the two? Um, I think core and that sort of it strips out something, obviously. Um, here we go. It shows you've okay, changing the total value of new purchase orders placed with the manufacturers for durable goods, excluding transportation items. So that's looking to sort of come down, but when you add sort of transportation items back in, presumably it's still negative, but moving in a positive direction. So a little bit of a mix with that kind of stuff there. But again, that's not going to sort of really blow the market out, I wouldn't say. And then sort of coming through, great deal, a whole bunch of speakers and that on wow, look at this. Must be something going on here because you got Williams, Bowman, Barr, Logan, Daly, all these people sort of speaking within a couple of hours of each other. We got core CPI for Tokyo, whatever. It's not going to affect me too much. And then PCE numbers at the end of the month, end of the week, 10:30 on the Friday there. And this is what supposedly the Fed use as their sort of preferred measure of inflation. This is a month-on-month kind of thing, and as you can see, it's fairly stable here. But again, it's one of those things to look out for. If we do get a bit of a spike up, we're going to get a lot of people sort of talking about sort of like, oh, maybe inflation is going to start to come through. So it's typical kind of thing, a little bit quiet for the start of the week. From Wednesday on, we're going to see things get a little bit busier. All right, let's jump into the charts and that as well. Not looking at UJ, we're going to have a look at DXY because DXY is something, if we can get to open, something that I think, as I said, could be at a pretty decent sized turning point. We did see quite a strong rejection from these lows coming up over here. I would have liked to see it close a little bit higher because if we have a look, I covered this the other day on this weekly, just managed to close itself just the tiniest little bit bullish, and that's a fairly big wick. But even though it's got negative divergence with a big wick here, had this sort of finished on a high, and no, we're only a couple of points off, and it really only just came back the last couple of hours, so that could have just been some pairing of positions. There's a chance we probably get a little bit of a dip early to put another little bottom wick in, but then certainly if we take out that high, not that one there, let's put a little alert here. I think this could sort of be a good sort of confirmation line. So taking out last week's highs. So above 97.86, I think is going to be fairly decent. As a little sort of bit of an indicator that we could be coming up a bit higher here. So that's the weekly, so negative divergence. This is the daily, a little bit of a sort of falling thing. We got three connections here and managed to push through. But this is what I keep saying with these things. When you have such chop, 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 you've got so many levels to deal with. This is the bottom of kind of what was that sort of range. I mean, obviously, we shot down out of this thing, but this is on the daily here. I know this point here. We saw this bounce, 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 bounce. It's an area in which they were trying to support it, trying to support it, trying to support it. It only stands to reason that, they try to sort of sell it from this point here as well. Double it here. Oh, okay. This one here. Bang, bang, bang. Even back here, bang. Quite a significant little level here. So this is why I'm saying that sort of like, take out that high, which we saw from Friday, which is also our weekly one, puts us back up into this little range, gives us a bit of a double bottom. We know it's coming off a big trend line coming down here as well. I think that's going to be quite significant. And this is where you see you got RSI is definitely at a room in a position in which it's happy to sort of push up and run here. I think this is what we're starting to see is that, you're starting to see that everybody's so hell bent on jobs being the only driver, tariffs and all this sort of garbage, tariffs have really proved to be mostly a non-event. Potentially, we're going to see some CPI and that come up, but it's not the sort of main thing that you hear every second day now. It's still obviously a driving force, particularly when it comes to gold and all this kind of stuff. But it hasn't really had the sort of major impact that everybody was like, oh my God, everything's going to sort of blow up. Like it hasn't really had that. And everybody's so heavily short on the dollar. Now they're sort of going, hold on, wait, given everything that I've just garbled on about in the last 30 minutes, where we could see, stronger economic data on the home front, we could see potentially inflation hanging around or actually trend a little bit higher. These kind of things are, hold on, maybe let's jump on board with the US dollar a little bit. Now, it's not at a point necessarily where it's okay, bang, we're coming up over here. These moves have to start somewhere. This has got a lot of technicals on the daily. RSI looks good. It's hit a level where we would expect the sellers to try and sort of hold it in place, bang, and they are. So it's not sort of saying, that's why we wait for the confirmation and say above this high here, we should open it up and then we look for the next level. So we look up towards sort of 98.50, 98.60. Should we break that high, 97.86? But the point is that sort of, you're getting all these sort of people that are so hell-bent on the jobs being the issue. If we start to see jobs actually sort of stabilize, if we see inflation stay persistent, if we see economic data good, these kind of sort of factors all jumped in together. If we see the jobs actually tick up, and look, I'm not saying they are. I don't. It's beyond my sort of expertise as to be able to call are the job numbers going to go up. But if they do go up, we react to those numbers, stronger numbers in the jobs, higher CPI, economic data good. When you get those three factors, that's when we're looking up back up over here. And I think this is why people are starting to close their shorts after they've swept the lows down here, is because it's not all just about the jobs now. And given these other factors, there is a good potential chance. And that's the thing, it's all about hedging because there's a potential chance that that outcome does happen. And if that outcome does happen, well, US dollar is going to appreciate. Do you want to be heavily short at 3-year lows? No, of course not. So they take their shorts off, and to take your short off, to cover the shorts, it's got to buy, and they buy it, and this is why we're starting to see it move up through here. Now, that's only good for so long, because it's not the only factor, and also those jobs are still weak. But, the thing is, it could definitely get to this point over here where people feel a little bit safer. If you get up here and then jobs actually go terribly bad, inflation comes down, well, bang, it can move back down, but you're covered a little bit. So I think US dollar is definitely sort of good for up around 99 through this period here. For the trade, above 97.86, I think is definitely an area where we could get a bit of confirmation, be targeting that sort of 98.50, above 98.50, then we can sort of deal with sort of 99.30, so on and so on. Let's put a little bit of a mark on these ones here. This level, bang, this level, bang, this level, bang. That's the kind of thing we're looking for. Should this thing start to sort of continue up, I would say at least these two are definitely, not without a chance of being hit. All right, so that's DXY. We got Aussie now. So I've covered Aussie a little bit here, and we are seeing a little bit of a push down. So again, starting the bigger thing, we got the weekly here. I did put it on this one, negative divergence on the weekly, and that was a nice little slap back here. Would have liked it to probably push down a little bit lower, but it's not without its chance. And this goes in line with the idea that we could see DXY put in a little bit of a top wick, but if we put in a weekly top wick and then take out the lows, then that's going to be the signal that we're going much lower because you've got the negative divergence, you've got the top of this sort of channel resistance over here. I guess we can kind of drag this up through here, use this as a bit of a target as to sort of how fast it comes down. So around that sort of 65 level. Then once this breaks, sorry, I should say if this breaks, but if it breaks, when it breaks, whatever, that's when you're going to start to see potential moves back down to 63. Like it is a possibility. Like we've seen this thing being stubbornly resilient, not strong, but resilient. Because you look at sort of the other sort of things. Like if you look at this side by side with euro, where's the euro gone? Oop, not that one. Keep you on there. You put you on euro and you on the weekly as well. Um, as I said, with these things, you can see the dotted lines. They'll sort of show the same amount of time. So both of their, at the time, their respective kind of highs. Euro came down, okay? Aussie came down, but look at where euro is compared to this high here. So this high over here at 69 cents for the Aussie, all the way down, bang, it's come up here, whatever that is, I don't know, 70, 78% or something, I think. Yeah, just shy of 78%. But then you look at what euro did. Well, euro went up over 1.61%. So you can see how Aussie has not been strong. It's been resilient. It's been resilient because US dollar's been so pathetically weak. But it's not sort of like, hey, Aussie's great, let's buy the Aussie. It's just been holding up because US dollar's been so weak. If you take that factor out, you're going to see Aussie sort of come back down. And as we've seen, that's a very good little top candle for euro there. And as we saw, obviously euro makes up 60% or so of DXY. But there's potential that we see these things. I mean, look at that last push to get up to those highs there. That is off nothing. There's no buying pressure here at all. If that sort of fails and comes back down here, that's, yeah, going to see definitely a little bit of a recalibration of that position. Anyway, back onto the Aussie. So that's what I've been saying. Like Aussie's been resilient. It hasn't been strong, and I think that's the difference. It's sort of like, yeah, buy the dip, buy the dip, buy the dip, and we've seen this over time and time again. But it's only because the US dollar's been weak. If you change that and US dollar starts to run and market starts to recalibrate that, what do you think is going to happen to Aussie? They're not buying it because it's good. They're buying it because it's the better of the two options, but with the US. If they're already not buying it because it's good, where there's no participants holding the price up in that regard. Well, if the one people are buying it because it's just the better of the two, they disappear. Well, that could be put it in danger of really getting smacked on the head from here, in my opinion. I have been saying this for for a little bit, and it has been up, 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 up. But yeah, we'll see how we go. So anyway, if we sort of jump down, this is on the daily. Look, it's come back here, stopped right on that little support line there. If you put on to the 4 hour, this is the chart that I put up on Friday saying, hey, look, we had two options from this area here to push down underneath. We did get down underneath. We got the retest, and then it's in this kind of third leg down here at the moment. So it was either going to hold here. If that's where they were going to hold it, that's where it was going to do. Um, it, I can't even say it tried to. I mean, it bounced about 20 points from its actual low, but it certainly didn't put up any sort of real sort of fight up above there. So, again, look, it closed on its sort of lows through here. If we get a push up early, and a rejection from say 66, 66.05, 66.10, this kind of area here, and then we take out these lows, that alert's still there. I think if you get down, look, let's be sort of, extra sort of confirmation, underneath these wicks over here, so underneath 65.80, that's your confirmation that we're going to be going a little bit lower. And then you can look at 65.50s, down at 65.20s, yada yada, all this kind of stuff here. But I think certainly, as I said, these kind of tops that you see, where it's kind of like that big spike up, take out all the sort of things, and then within the one candle, it reverses and comes down. Look at the flow on effect that you get after these things. Even this one here, look at how tricky this one is. 1 point or 2 points above these wicks over here, retest the bottom side of this zone, which I always say 60s, 90s, and 20s for Aussie, and bang, you can see here in the chart the repercussions of how this sort of came down here. So I think CPI is going to be very important this week. I think sort of like if we see CPI come in weaker, that could really sort of put pressure on the Aussie. If we see US dollar running at the same time, there's two factors really sort of slapping it down. So yeah, it's going to be quite interesting, that one there. All right, on to something that's just stubbornly strong is gold. There's another chart here. Sort of notice this little line here before. Like this is the big breakout. I mean, everybody knows the big breakout. We break down through this thing. This moves through here. One sort of thing I did notice this little line back over here. If we carry this all the way through, this is pretty much giving us a new support line through here. Let's make it a bit flicker. It's on the 4 hour, yeah. So, I mean, this is not really something I would normally go off, but this was something that it hasn't really touched on. I mean, a couple of good touches here. Get rid of this because I didn't play out. Clear up the chart a little bit. Bang. You can kind of see that, let's get rid of this stupid curve line, that this is something that it is kind of reacting to. Let's highlight a little bit. Boom. We got a couple of touches here, 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 and whoop, way off on its massive tangent. And here we are touching it again and again and again. So I think this is going to be something that when it does break, who knows when it's going to break, could be something that sort of gives us. And this is what I say. Look, I don't like curved lines. I just, for me, whatever, they don't work. Let's update this. You're a new all-time high. Actually, let's just do another one here. Update these later. But boom, there's your new all-time high. Look at how many times it makes all-time highs, and it's on a big run. So anyway, the point is that sort of like, yeah, you've got from this little wedge back here where it kind of exploded up. This was your breakout move. It's come back and finally touched it here, and we saw coming into the end of the week they bought it up. Now, gold, that's on a sort of, I mean, the wider view is obviously bang, massive breakout, yada yada. We know that. If we zoom down into, say, the 1 hour, have a look how we're doing sort of intraday. Um, look, it was sort of coming down. It was looking good. It was looking good. And then obviously into the end of the week. So from 11 o'clock last night, they decided, okay, let's flick the switch and start buying it. There's not really too much of an issue with that. Mainly just sort of the fact that that seems to be the theme more recently of buy it up into the weekend. You know, I mean, nothing really seems to be on the radar at the moment in terms of sort of geopolitical things about to blow off over the weekend. So we'll see how that goes. If nothing happens, I expect to probably get a little bit of a push down on open. But this is still, I mean, look, you're $20 or so from all-time highs. $30, $20, $23. Yeah, I'll get there. $23 from all-time highs. So, you know, and I mean, it's still very much, you know, and this is, I mean, it's so incredibly strong. It's still got a bunch of sort of factors, I suppose, like Ukraine's or whatever, all this kind of garbage stuff. But, yeah, I guess you got to factor this stuff in. Um, Point being is can be updated because that's not relevant. None of this actually really is at the moment. Um, it does look very strong. It does look very strong. Where we at the daily here, the weekly. Yeah, so weekly at one point when I did the video yesterday, I think, or up until the last couple of hours of the thing, was very much looking like it might be sort of cruising a little bit, like it was around the sort of 40s area. Obviously, put in 27 or something low, but it was looking like a nice little top wick here. Doesn't mean that this is necessarily, you know, going to continue and fire up over here. We're seeing on the daily that RSI is definitely cooling off here a little bit with this push up here. So again, look, I think two levels that I'm looking at. One is this full rising support. Let's put it like this, and so this is the breakout rising support. And then this little level here, which is those lows, 3610. What did I have that? Breaking weekly lows. I don't know. Whatever. Losses. 3610. Short-term ledge. Kind of, I guess if you want to call it, kind of be a bit of a swing low kind of thing in this regard as well. But if we look at this just on the daily here, RSI wasn't really there. Look, it closed on its highs. You can't sort of go, okay, it's bearish now. But if you break this trend, if you break this like 3610 level, that could be when we start to see a little bit of a cooling. So look, it's hard to sort of get it, and that's where the confirmation line would be to sort of see this thing to come back down a little bit lower. Then we could look at some other trend lines and yada yada and sort of work out where it's going to come back to before the buys come back in. But I think sort of underneath 3610, you're probably going to see a little bit of a cooling. If we get nothing over the weekend, if we see US dollar run, These are the kind of things that might sort of actually be able to sort of slow this down a little bit. Because it's been an absolute bull of a thing. And certainly this is one thing that I've a little learnt with this. If you're long on this, because I'm in and out, in and out, in and out, but if you're long on this and you hold a core position, how many chances have you had to get out? You know what I mean? It looks like it's over. No, it pushes on. Looks like it's over. No, it pushes on. Looks like it's over. No, it pushes on. You hold that thing and hold and hold and hold and hold. So, you know what I mean? That's, yeah, something interesting to sort of take away. But the metals have been pumping. I'm just having a look. Silver just popped over 43 to close the week as well, up 3% for silver. Jeez, that's crazy. Anyway, so point being is we have a little bit of a sort of, call it a little bit of a range up over here. Um, it's not really a range, actually. That's just a low, whatever. The point is that sort of you've got a bit of resistance up over the top over here. You break through the highs on it goes with the show. But if we can see US dollar strengthen up a little bit, that's going to at least slow it down. It doesn't mean that you're going to get like gold and US dollar have a sort of weird relationship, whereas used to call it the 90-10 kind of rule. Like 90% of the time they're inverse, 10% they move together. But more recently, like with a lot of correlations this year, everything's just going all whenever it wants, and gold basically just goes up. Doesn't really care what US dollar's doing. But the point is that sort of like when US dollar's not an option, golds are higher. Like you got to think about it like, in market participants, if there's no option or there's no benefit to be sort of buying US dollar, well, you got to put your capital somewhere, buy gold. That's great. Just because US dollar is getting bought up doesn't necessarily mean that gold will come down, but there's less participants to be buying that gold. So it could slow down the actual growth of the price. So it's not necessarily that US dollar runs that this is going to come massively down, but it does mean that it could potentially slow the rate in which it does go up. And if we see it slowing the rate of it does ever moving up, that could lead people to go, hey, hold on, wait, well, maybe the move's just slowed now and we start to see some range sideways. Uh, if this thing's not moving up, let's jump onto something else that is moving, maybe the US dollar then, and then we could see this thing come back down. But I think underneath 36 to be safe, 36.10, but call 36 because, round number, all this kind of thing, through this trend line. And then I think we could sort of see a little bit of a cooling down, maybe around sort of 35, 35, 30, that kind of level down over here. That's all very well. That's a bigger plan, I guess. Yeah, daily. Let's see how it opens for the week. But I think sort of if there's no catalyst for this big bit of buying here, which I can't see anything as of yet. I think you could see a little bit of that sort of peel off, and they're the two levels that I'll be looking for on the downside. Fly along, we've got copper again. Look, I'll keep charting copper, but as I said, I think this market's kind of broken for now. Look, I mean, I guess there's a little bit of a trade here. If we look back at sort of its previous movements, it sort of does a lot of this up and down choppy sort of stuff. But I just sort of think that anytime maybe if you want to buy some big dips, you could sort of get into something. But I think anything that moves up is just going to be sold into, as we're seeing this each time it sort of levels up a little bit. So, yeah, it'd be interesting to sort of see where this sort of goes over maybe the next 3 months. But for now, I think it's a bit of a snoozer. And finally, just the yuan. This is a big one. I mean, obviously, look, this thing's trying to sort of pick some action with this stuff. For a seemingly slow moving pair, I seem to have a lot of sort of directions and arrows and pinpoints and that on this chart. But because I do think it has a strong correlation with gold, with Aussie, and by extension, I guess US dollar because it is against the US dollar here. But again, start on the outside, start on the bigger time frame on the weekly. That's a big rejection from a known support area. And this is what I say, that's sort of like, this negative divergence is on the daily. So let's get this off here. Put on the daily. Kind of interval only. And we've seen here, negative divergence into the weekly supports. It's bouncing back up. 715 still the level to beat. Get above 715. You're looking to move up to 722. Above 722, well, you got something going on. And again, this is what I'm saying, that sort of like, the things that'll get to these levels are one, peeling back the US dollar short positions for everything that I've mentioned through this video, but to get about above over here and move back up over here, you're going to need probably, or you're definitely going to need more things happening, but you're going to need to see stronger conditions from the US. And those stronger conditions are inflation persistent and remaining higher or even accelerating the better in terms of sort of US dollar strength, jobs stabilizing, jobs gaining the better, and stronger GDP and retails and the other economic data that goes along with that stuff. Now you get that, plus also then you got to actually factor in the Chinese, the PBOC or whatever. But those sort of things, if you get that right secret source of it all, that's when you move up over here. And when we see it move up over here, we start to look at this whole ascending triangle setup, which really, it could come back down here. Could become, I mean, look, this could take us through till September 26. This is a big, big, big move. But if we see this thing confirm up above these levels, well, you can then say it's going to 735. Most likely they'll hold it there. We'll go through a cycle back down. And if it confirms again, moving up through here, I mean, this is long-term talking, but through to 726, that's potential for this thing to absolutely explode out the top side. And that means that US dollar strength, it means super weak yuan, it means weak Aussie. These are the things that'll sort of happen, if we get those little bits of sort of data and sort of conditions set up. But, this is why sort of like I saw some banks call for Aussie to 89 cents by end of next year or something, which I think is almost like not only just stupid, but irresponsible. I would say is probably a better word for it because it's like I don't have a comment on these things and it probably just goes into the wind anyway. But the the point is they said they expected to drop to 62 cents in the next 3 months, which everything I covered there does actually sort of promote that idea. But then sort of what was it? 89 cents by the end of 89 cents by the end of 2026. So probably better if I have to find it, but is this one? Where is it? Ah, here we go. Here, yeah, Robobank or whatever. Continue to forecast a moderate uptrend in the currency pair into next year. We see scope for a short covering in favor of the US dollar, which is everything I've been saying, on a 3 to 1 month basis. We scope to move back to 65, not 62 for them. Okay, well, maybe. And then moves to 89 cents in a 12-month view. And this is what I'm saying. That's sort of like I said, maybe, but 9 month period then, because over 3 months and then 12 months, there's obviously a 9 month difference with those. Going up 37%. Yeah, okay, maybe. Look, I definitely could be wrong, but I absolutely highly doubt that. Anyway, we'll see how we go, and I very much could be sort of shown up to it all. But anyway, the point is that back to what we are talking about with the USR yuan, it's coming off a weekly support area. It's got a big negative divergence. This is going to be the falling resistance. Is going to be the first test. Second test above 715. Over above 715, if you chuck onto the 4 hour, obviously we got that little mark there, sort of saying that, hey, look, this is going to be an area where we're going to open it up a little bit more. And then really you back up into this sort of area. And again, once you've taken out these big lows and you start to push up, you start to squeeze. And once we squeeze, 722, 723 is kind of pretty much where we're going to be looking for. All right, that's it from me.